Good afternoon, class. Welcome back to this session of modern organization and management. In our earlier session, we spoke regarding different methods of, controlling in the organization. Now, I shall repeat it once again. When what has been suggested in your syllabus is uh, with regard to that of financial control. Under financial control, we saw especially the budgeting control, we saw break-even analysis, we saw standard costing. And yes, we can also include the responsibility accounting and internal accounting. That is what has been mentioned in your syllabus. Now we all also spoke about operational control and inventory control. Now, how much financial control is necessary for any organization? Even operational control and inventory control are equally important. Though it has not been mentioned in your syllabus, we discussed from the point of view because you have to understand the overall control techniques or the fact that whatever various control techniques we discussed, now they are partial in the sense that is they apply to few part of the organization and they will not be able to measure the total organizational performance. So, when it comes to the ultimate strategies that are to be taken, now this top management, shall always be more interested in the total organization control. It can be finance and non-financial. So, there are various techniques for overall control. Now, these are financial ratios, which include return on investment or management audit or social audit, or we can also take into consideration human resource accounting or management information system. Now, some of these examples that I have given, they are of direct control. It could be financial ratio analysis, and quite a few are indirect control. But both these types of techniques are used for overall control. Now, this financial ratio analysis. Now, if it has to be said in the form of definition, now it is a process of evaluating the relationship between component parts of financial statements to obtain a better understanding of firm's position and performance. What happens here? Here normally we take into consideration components. Components such as maybe debt, equity, inventory, or you know mm, the interests that are to be taken into consideration, the assets, liabilities. Now there are few of the relationship between all these components, and we normally do it through the basis of formulas. How we can understand the relationship among all this. Now, this financial ratio analysis is something which you would be using in your fourth semester when you have to do your project. Most of you would be doing it. So, what are this? And you will be studying about this in your third semester with the subject management accounting. So, what are these financial ratio analysis? Now, they identify the relationship between two financial variables. And when they identify this relation, they would be able to derive meaningful results about the behavior of these components. And the type of relationship, to be investigated normally depends upon what is the purpose of analyzing. What is that the management actually wants to know? On the basis of this, what ratio has to be calculated would be decided. So, normally now there are number of ratios Now there is no limit as to this, but the main ones that has been considered here. Now it can be liquidity ratio, activity ratio, leverage ratio and profitability ratio. Now speaking about the first one, liquidity ratio, now it tries to establish the organization's ability to pay for all its short-term debts. Now, normally it would be in the form of current ratio and quick ratio. Now, speaking about current ratio, it shows the relationship between the current assets and the current liabilities. So, what does this mean? The relationship between current assets and liabilities. So, this indicates the extent to which current assets of an organization are adequate to pay the current liabilities of the organization. That is current ratio. Then we have quick ratio. Now, quick ratio, it indicates the relationship between the liquid assets and the current liabilities. So, what are these liquid assets? Normally cash in hand and cash with the bank and short term debtors are considered as liquid assets. So, quick ratio, it tries to find a relationship between liquid assets and current liabilities. So, it helps in determining the organization's ability to pay its current liabilities without considering inventory in hand. And then we have activity ratios. So, this activity ratios, when you try to get results from it, it will give us or it will show us how funds of the organization are being used. And it is in the form of first one, inventory turnover ratio. Now, this inventory turnover ratio, it shows the number of items or sorry, the number of times inventory is replaced during the year and shows how effectively inventory has been managed. That is to tell, in 365 days, how many times is it necessary for your organization to bring in stock for the organization so that there is no any problem in the day to day working of your organization. Now, whereas this receivable turnover ratio, it shows how promptly the organization is able to collect dues from its debtor. That is, whether their whether the money that they have given out, whether it would be coming into the business at the time when it is necessary. Along with these two, we have one more, that is asset turnover ratio. Now, asset turnover ratio speaks about how effectively assets can be used to generate sales in the organization. Then we have leverage ratios. So, this leverage ratio, they indicate the relative amount of funds in the business supplied by creditors or the financiers and with that of shareholders or owners. So, these ratios, they are normally in the form of debt equity ratio, it would be in the form of debt total capital ratio, and also it is in the form of interest coverage ratio. Now, speaking about the first one, debt equity ratio, it shows the proportion of debt in relation to equity. Okay, and this is one such ratio which shows the financial strength of the organization. Now, speaking about debt total capital ratio, debt total capital ratio shows the proportion of debt to that of total capital that is being employed. So, this also indicates the financial strength. Speaking about interest coverage ratio, it shows the interest burden which is being borne by the organization in relation to the profit that the organization makes. And then we have profitability ratio. So profitability ratio shows the ability of the organization to earn profit in relations to its sales or investment. So profitability ratio are expected in terms of profit margin as well as return on investment. So profit margin either can be net profit or gross profit is expressed in the form of relationship between profit and sales, and also it indicates the degree of profitability of business, whereas return on investment is measured by relating profit to investment. Return on investment is one of the most comprehensive technique for controlling overall performance. Therefore it is somewhere more elaborated discussion is necessary, which is outside the scope of your subject. So that you shall be learning later on in your other papers. The next one is under the overall control technique is return on investment. So what is this? So the efficiency of an organization is normally judged by the amount of profit it earns to the size of the investment it has made. So this is called as return on investment. Now this is one of the important approach which has been part of control system of DuPont company. Now since 1919, though it was actually devised by you know Donaldson Brown in 1914, since its successful operation in DuPont, a large number of companies have adopted it as their key measure of overall performance. Now this technique does not emphasize absolute profit for judging the efficiency of an organization or as a whole or a division thereof. Rather, the amount of profit is related with the amount of facilities or capital invested in the organization or the division. Now, the goal of a business accordingly is not to optimize profit but to no optimize return on capital invested for business purpose. So this standard recognizes the fundamental fact that capital is the main factor in almost any business, and its scarcity puts limit on the progress of the organization. Now what you can see in the picture is the system of control that is being taken to return on investment as operating in DuPont company. Okay. Now, normally the rate of return is calculated by dividing the profit by total investment, and it can be computed in respect of historical data so as to reveal the rate of return realized, or it might be applied to budgeted data to give a project rate of return. Now, um, speaking about the advantage, this technique it offers a very sound basis for inter-organization comparison. So such comparison can be made among different division, departments or products of the same organization. And it places high values on the effective and efficient use of organization resource. And it also acts as a mirror which reflects the entire image of the operating activities. Second one is it provides success to budgetary planning and control by putting restraint on the manager's demand for high allocation of resources for their departments, even if they are not actually necessary. So the resource allocation in an organization is made more on rational basis, and also it is helpful in authority decentralization. Now each manager who is in charge of department or section is responsible for earning certain rate of return, but enjoys complete freedom in running his department. So such autonomy gives additional incentives to manager to become higher side of to become more efficient. And it also tries to create total control system, that in the sense that rate of return reflects the objective of the organization. Now if this rate is satisfactory, other control systems like budgetary, costing, ratio reports may be taken as satisfactory. Now speaking about limitation, now this the use of rate of return, it is associated with the fixation of standard rate of return against the actual risk compared. So here the difficulty is, what should be the standard rate of return is always questionable. So comparison of rates of return are hardly enough because they do not tell what the optimum rate of return should be. And another problem comes in the way of valuation of investment. So the question is, at what cost the assets should be valued? That is, you have various ways how you can value assets. Now you have studied under your accounting. Sometimes you calculate on original cost, sometimes you do it on depreciated cost, sometimes you can do it on replacement cost. Um, so it becomes difficulty as to what is that you want, how is that you want to calculate asset. And in the benefits we spoke about comparison. So what happens if one company valuates it on the basis of original cost, other does it on the depreciated cost? How will you able to compare it? So there is a lot of confusion if we have to spoke about the limitation of this. Now, in inflator economy such as of ours, the problem of price adjustment becomes more accurate. So, whatever basis of valuation is adopted. And then we have the rate of return on investment, sometimes hamper diversification if it has no flexibility with it. Now, this is because of the fact that the rate of return is determined by the amount of risk. That is, higher the risk, higher the desirable rate of rate. Now then we also have this, the rate of investment is followed so rigorously that expenditures such as research and development, which can contribute to profitability in the long run, are curtailed to show impressive result. Now the one more limitation is that now in case of most of the control based on financial data, return on investment can lead to excessive emphasis on financial factor. So this emphasis that capital is the only scarce resource in the organization, leaving aside the role and availability of component manager or good industrial relation and good public relations. So these act as quite a few limitations of it. Now, in this way of doing overall control system, we do have this management audit also. Now, the various control tools, whether responsible for controlling the activities of the organization as a whole or of its particular segments, focuses attention on the end results of the activities. So the actuals are compared with the standards. Now they do not or they never focus attention on the quality of managing as a system. Since the quality of managing ultimately makes the difference, between the success the organization will embrace or the failures that it has to face in the organization, this quality should be given a different assessment from the ability of the organization to do well in particular functional area or operational area. So, management audit is one such attempt in this particular field. So, what is this management audit all about? Now, under management audit, what we do is we try an evaluation of the management as a whole. Now, it is an independent and also a critical examination of the entire management process. So, in doing all this, it tries to examine the total managerial process. So, what are the process? Normally, it is planning, organizing, staffing, directing and controlling. So, it indeed companies plans, objectives, policies, procedures, organization or system of control personal relations, all these things are measured to evaluate the management achievement. So there are certain problems in management audit. Now, because of it being a new control device, the basic question involved are about the scope and procedure. Now, people who should conduct it, the characteristics and the qualification of these people, and the person to whom the audit should be submitted. Now, so far as the scope and procedure of management audit is concerned, these are not fully defined because of widespread variation in practice in management audit. But similarly, there is also lack of well defined principle and procedures. So much depends upon the skill and the tact of the management auditor. Now, normally this management audit, it takes the form of reports. So the report should be specific and must go beyond the typical audit reports. That is, for a management audit to be meaningful, it would require that the quality of the managers and the system within which they manage must be assessed objectively in fairly specific terms. The reports must be submitted to the top management. The auditor has to report the deficiencies of the top management to the same people. So this is not an easy hurdle to overcome unless completely objective standards have been agreed upon and applied impartially. But what we have to see is that management audit, in spite of the various difficulties involved in its operation, it always tries to provide the way to measure, the effective to control tool. However, its effectiveness depends much upon how the various problems involved in management audit are overcome. Now, this is one such field which is still emerging and which has a lot of scope to be studied on. Now, one of your seniors, not the one who is just next to you, but the one batch which had moved out of college, there was one student who had done their project, I mean her project on this concept of how would the ability of management reflects on the share price of the company. It is a very good project that had been done. Now, once if at all the college opens, maybe you can refer to that book so that you can understand about this management auditing in a more precise way. Now, the next one is social audit. So, what is this social audit? Now, this is this is few times in business where they are trying to speak more about how good the organization is for the society, how good the organization is for the environment. They're trying to focus that they're actually not doing business but they're doing service. So, that is the question where we can speak about this social audit. Now, it is concerned with the social performance of an organization as contrast to that of its economic performance, which is measured by the financial audit. Now, this concept of social audit was first developed by Bowen in USA in 1950s. It is more recently that business organizations have given some thought to this aspect of business performance measurement. Now there are various operational approach for the defining what social audit is. First is that the social audit is taken in terms of measuring the total expenditure which the organization would be bearing for the social activities. Now this approach, it includes the recognition of the cost and the search for ways how to reduce such costs. The second one is the social audit is designed in such a way that it measures the value of productive capability of organizations human resource and the value of various parties external to the organizations, but who are in a continuous interaction with that of organization. That is productive capability. The third one, now under this, a program management approach of social audit, which especially focuses on measuring only those activities in which a particular organization is involved, largely for social reasons, are considered. Now, in a fourth way of doing social audit, there is an inventory approach of social audit, and it involves the cataloging and describing what the organization is doing in each area. Now, it recognizes that society expects the organization to do something. Now, under fifth, there is a cost or benefit approach. Now, it tries to quantify values contributed to the society and determines to the society for actions taken or not taken and array them in a fashion comparable to typical financial balance sheet. So, these various approaches of social audit, they provide different measurement yardstick. Now, yardstick is nothing but a scale, to be very, very simple. Okay. Through all approaches, all these approaches lead to the same measurement, that is an organization contribution, is the organization doing any kind of contribution to the society. So this social audit has been defined as, a commitment to systematic assessment of and reporting on some meaningful definable domain of the company's activities that have social impact. But remember one thing, now this social responsibility has become compulsorily on the part of corporate. But the thing about business is, we do business to earn profit, not to do social service. But that is to tell, the whatever they speak of, we are doing so much percentage for, we are spending so much for the society. Ultimately, if it is being done forcefully, then they know ways how they can put this expense on the head of their customer instead of them contributing truly to the benefit of the society. Now, there are very much problems in this social audit. The first one is scope of audit. That is to tell, scope of audit, or in simple ways, the areas that it includes. Now, if social audit is to be made, the basic question is what activities should be covered. Now, there may be various alternatives. First is all social activities which is being performed by organization may be taken for reporting. However, if the social audit is to catalog all such activities, verify the costs involved and evaluate the benefits produced, it is very impractical to carry on the social audit. And the information may be too massive to be useful. So the activities may be too large because it is very difficult to say which activities are not social. So various activities which an organization does uh, are social from one point of view because they provide some social benefit, besides benefiting the organization as well. That is, when an employee is hired, definitely it is for the making things done in the organization, but in paying the salary, it somehow benefits them also, benefits the society also. It gives job opportunities for people, it increases their standard of living. So actually we cannot make out what is not helping the society. Now, within this scope, the second one is that there are various activities of clear social utility without, prospect of profits may be taken into consideration. But then only such activities are taken into account. The scope of social audit will be too limited to demonstrate the extent to which the organization's performance is fulfilled. And the second problem is measurement of problem. Now, another major problem in social audit is related to the determination of yardstick for measuring the cost and accomplishment of activities included in the social audit. Now, though costs can be measured easily, these are not the true reflection of social responsibility. There are chances that this may not be the result of social involvement at all. So the measurement of benefit is much more difficult because of lack of objective qualification of the outcome of any social activity. Moreover, how much an activity is benefiting to the society and the organization concerned is difficult to measure. Normally, this social audit would be in the form of social audit report. Okay. Um in spite of the problems, the organization may think of it because a time may come when social audit like financial audit becomes compulsory. So the validity of social audit report may be determined on the basis of well established financial audit reports. That is, use of which information will be put should govern both the conceptual and procedural basis on which information is prepared and disseminated. In the same way, the next one is human resource accounting. Um, now, this is one such uh, which puts a lot of scope in understanding the overall control techniques that can be used in the organization. So, that is to tell in this present context, the organization, they have realized that human resource are the most precious resource. Therefore, they have not only taken measures to develop their human resource, but also taken measures to value this resource. Now, this is happening throughout the world, and we can see many companies who are doing this human resource accounting. Now, financial accounting has developed various tools that largely measures activities and their result in such areas as cost, as profits, etc. Now, these do not make an attempt to measure the value of human assets. More important than financial assets, which make the most difference in the ultimate results. So now, in order to bridge this gap, behavioral scientists have made attempts to measure the value of human items. Now, an early attempt was made by Likert and Bowers. Now, this attempt was further extended by others to give some, concrete shape, which has generated human resource or asset accounting. Now, if we have to speak about human resource accounting, now it is the process of identifying and measuring the data about human resource and communicating this information to the parties who are interested. So, this definition was given by American Accounting Association. This human resource accounting is the process of identifying and measuring data about human resource and communicating this information to the parties interested. So, human resource accounting is, primarily involved in measuring the various aspects related to human assets. Its basic purpose is to facilitate, the effective management of human resource by the way of providing information either to acquire the human resource or to develop the human resource. It can be to retain them, utilize them, and also evaluate them. And in selling, so the objectives of the human resource we can know, that is, it tries to provide cost value data for the decisions that are to be made by managers, especially regarding acquiring, developing, allocating and maintaining human resource, so as to attain cost effective organizational objectives. And it tries to provide information to monitor the effectiveness of human resource utilization. It tries to provide information for determining the status of human assets, whether it is conserved properly, it is appreciating or depleting. Now, to assist in the development of effective human resource management practice by classifying, the financial consequences of these parties. So these are some of the objectives. Now there are different methods of valuation of human assets. In that, first is historical cost. Now what happens is that here it is based on actual cost incurred on human resource. Now such a cost may be of two types: acquisition cost and learning cost. Now acquisition cost is the expense incurred on recruitment, selection and placement. Now, while calculating the cost of recruitment and selection, entire cost is taken into consideration, including incurred on those who are not selected. And learning cost involves expenses included on training and method. So, this method is very simple in its application, but it does not reflect the true value of human asset. For example, an experienced employee may not require much training, and therefore his value may appear to be low, through his real value is much more than what is suggested by this historical cost method. Then we have replacement cost. Now, as against to historical cost method, which takes into actual cost incurred on employees, replacement cost takes into account the notion cost that may be required to acquire a new employee to replace the present one. Now, in calculating the replacement cost, different types of expenses are taken into account. It might be in the form of acquisition and learning cost. Now, it is generally much higher than historical cost. Now, one main problem is that true replacement of a person may not be found easily with whose cost the valuation is done. Then we have standard costing. Here what happens is, instead of using historical or replacement cost, many company uses standard cost for the valuation of human assets. Now, just as it is used for physical and financial assets, for using standard cost, employees of an organization are categorized into different groups based on their hierarchical position. So, standard cost is fixed for each category of employees and their value is calculated. Now, this method is simple, but it does not take into account differences in employees put in the same group. In many cases, this difference might be, very much a vital information that has to be considered. Then we have present value of future earnings. Now, what happens here is, the future earnings of various groups of employees are estimated up to the age of their retirement and are discontinued at a predetermined rate to obtain the present value of such earnings. So this method is similar to present value of future earnings used in case of your financial assets that we do. But then this method does not give correct value of human asset, as it does not measure their contribution to achieving the organizational effectiveness. Then we have expected realizable value. Now the above method that we discussed are based on cost consideration. Therefore, there are chances that these methods may provide information for record purpose, but they never reflect the true value of human assets. As against these methods, expected realizable value is based on the assumption, and this is true also, that there is no direct relationship between cost incurred on an individual and his value to the organization at a particular point. That is to tell, an individual's value to the organization can be defined as the present worth of the set of future service that he is expected to provide during the entire period that he is going to remain in the organization. Now, what this particular slide is that it speaks about the different variables which affects an individual's expected realizable value, and also the individual condition values and his likelihood of remaining in the organization. Now, even human resource accounting has its own advantages and problems. Uh, Speaking about advantages, it definitely helps in giving valuable information to the management in the way of them affecting, making effective planning and managing human resource. And it also helps for measuring of standard cost, which is concerned with recruiting, selecting, hiring, and training people, and organization can select a person with highest expected realizable value. Now, this human resource accounting, it also helps from the point of view that it can change the attitude of managers completely. Thereby, they would try to maximize the expected value of human resource and the effective use of human resource in the organization. And it also provides necessary data to devise suitable promotion policy, congenial work environment, and job satisfaction of the people. Now, there are certain operational problems in this human resource accounting because it attempts to measure intangibles. So, it is always includes subjective factors. Now, these subjective factors normally may play crucial role. So, the major operational problems are that there is no well set standard accounting practice for measuring the value of human resource. In the case of financial accounting, as we observed, there are certain specified standards which every organization follows. But when it comes to human resource accounting, there is no such standard. Therefore, various organizations that adopt human asset valuation use their own models. With the results, value of human assets of two organizations, it is very difficult to compare. Now, the valuation of human assets, it is based on the assumption that the employees may remain with the organization for certain specified period. However, it might not hold good in today's context because of increased human resource mobility. And it is generation Z that is the workforce now. And there is a possibility that human resource accounting may lead to dehumanization in organization if at all the valuation is not done properly. And there is also possibility that the trade unions, they may oppose the use of human resource accounting. Now they may want parity of wages or salaries with the value of employees. So this is all about human resource accounting, what you can do. Now all these 5 things that we saw are overall management control techniques, that is financial ratio analysis, control through return on investment, management audit, social audit, human resource accounting. And one more that you know is management information system. This I definitely know that you all know how it works. Under this you can speak about designing of management information system for an organization, uh, the determinants of it, how would be the management information system blueprint, and the role of management information system in controlling. So these are quite a few techniques that has been said to all you. The types of the controlling has been said in detail. The meaning of each I have tried to put up in brief. If you have any doubts, you can always just post text and I would let you know. Now there are two more topics that is there in your syllabus. The first one is regarding information control. So now is it very much necessary that we control information in the organization? We tell that information is the lifeblood cell. So why to control it? Is there any problem that information is posing? Now, in answering all this question, we definitely live in the age of information. And as our technological tools advance, so does our availability to store vast amounts of information about people. So today we shall try to understand information control from the point of big data that the companies are having today. Okay. Now this big data, what is this big data? Now I would like to give you a do it yourself task. Try go and find what big data is all about. Now this is the talk of the day in today's business world. That is how to maintain, preserve these big data, whether there is a use of it to the organization, whether it is just a cost that has to be incurred, or how to manage it. All these things, do or do it yourself task. Try knowing what big data is all about. Now coming for this information controls, now organization of all size in all industries, now they are trying to find new and efficient ways to use the information that they are collecting so that they can come up with business strategies. And in doing so, they should always consider the ethical obligations which comes with handling vast amounts of personal information about people all around the globe. Now, as our digital infrastructure goes, the field of information management is developing fast alongside it. So, what is this information management? Now, as it sounds, it is nothing but the collection and management of information. Now, this information can come from a range of sources. It can be stored in variety of formats and it can be distributed to more than one audience. And in today's world, information includes both electronic and physical information. Now, the most commonly used in modern age is that of digital data. However, the term spans to include paper documents and other electronic documents such as audio, social, business, and video content. Now, as if I have to mention this as a field, information management it determines how people and organization work with this information. That is, weighing up the practicalities of how to handle it. And also taking into account the ethical consideration of managing what is time sensitive and private information. So, information management is an organization's responsibility and needs to be considered not only by most senior levels of management but by employees at every position in the company. And of course, you know, this information it is the lifeblood cell of any business organization. So it helps decide how business can form their strategy and also implement process based upon this information that has been collected. Now this information management it is the heart of business growth. So which is why so much effort and resource are always put into developing efficient information management system and also qualified professionals to help implement them. Because today collecting data is easy and data would be collected in huge number, in huge scale. But we'll have to be very careful in analyzing what is that is useful for our organization and what is that we'll have to have. Because even though you are having huge amount of data, if it is not going to provide any kind of insight, it is of no value or no use for the organization. It just only becomes a cost consideration that has to be maintained. And the second thing is there is a lot of ethical issues that are to be considered in collecting all this information. Um so it becomes very important that, especially with the large organizations, how will they maintain their big data? Now data is also so much. Now you might have used different shopping websites. Now once you use certain kinds of product, that products you see in different social medias also, that if at all you have searched a product in Google, the next time that you see YouTube in the advertisement, A commercial would be related to that particular product that you have searched, or advertisement might appear with regard to that. So how did that happen? Now that is where all this data are considered, and that is how large companies use their big data. So there are quite a few ethical considerations that are to be made. So the big question is how to manage all this information that the organization have access to. So this management information system have become one of the integral part of business internal operation. Now this hardware or software is developed to help the organization to control, store, create, collect and also access huge amounts of information which can be included like tools for managing customer relationships to financial system to organize invoices and payments. Nonetheless, business of all size will to some extent have an MIS system, whether it is simple as storing customers' phone number or as complex as building customer profiles based on the range of provided data. So, MIS is at the heart of improving an organization's efficiency. Learning how to use this software, evaluate it, develop, and improve it is at the heart of many information management qualification, making graduates sought after employees in nearly any industry. So that is with regard to this information control. Then we have something called as benchmarking of the best practices. Now what is with regard to that particular sentence that is there in your syllabus, what is best practice is always a relative term. That is, what proves to be best for my organization is far different from what proves to be best for some other organization. And one thing is that a particular practice can be best when it is under certain context or it is a contextual basis situation. So rather than us considering quite a few things to be the best, it would be better if we understand what benchmarking is all about, so that when it comes to the point that you have to tell what is best for you, you would be able to tell it. So what is this benchmarking? Now you might have heard this term a lot. Now there is also chance that you might have assumed that it was just another management tool to be utilized or rejected according to individual circumstances. Now in fact this benchmarking in after 1990s is not a choice, it has become necessary. So this is the method that Japanese adopted after World War II to create an economic superpower, uh, in the same that the corporate world must learn to master to survive in the increasingly competitive global marketplace. Now the penalty for neglecting proper benchmark is loss of competitive edge at a time when the consequences of such loss are more devastating than ever. So this term bench or BNCH comes from topography and it refers to mark made upon some object in a landscape indicating its evaluation. Now to be used as a reference point by surveyors. But with the topographers, they have the whole landscape to measure. Nothing is concealed. Whereas benchmarking in the business context, it involves taking measurement of a corporate landscape whose dimension will probably not be immediately apparent. So to be successful, it always requires combination of solid detective work, honest self-examination, and also a will to innovate. So normally there are four types of benchmarking, that is internal, competitive, functional and generic. Now, this internal. Here, the process of comparing one particular operation within your organization with another. So, success in this area is the matter of the left hand knowing what the right hand is doing. It is as simple as that. So, internal benchmarking is by far the easiest both to research and to implement, and productivity improvement achieved in this type is usually 10%, we can tell. Now, competitive. As the name suggests, the process of comparing an operation with that of your direct competitors. For obvious reason, no, definitely this is the most difficult type of benchmarking to carry out successful. And legal consideration must always be kept in mind. So, productivity improvement achieved in this type is usually 20% can be. Then we have functional. So under this, we do compare an operational operation with that of similar ones with a broad range of industry. That is to tell copper mining techniques compared with maybe coal mining techniques. So functional benchmark is relatively easy to research and implement, and productivity improvement achieved under this type is for at again 35% or better. Now speaking about the last one, generic. So this is the process of comparing operations from unrelated industries. That is, it would be a film library using the warehousing techniques of another industries to store more efficiently its catalog of old movies. So the advantage of this type is that the problem of competition do not apply. So increasing the access to information and reducing the possibility of legal problems. So productivity improvement achieved in this type may be 35% or better. So what is this best practice? Now the recognition of best practice is somewhat subjective, but to increase the objectivity of identifying a best practice, you can have quite a few guidelines for yourself. That is to tell, a practice method or process may be deemed to be best if at all uh, it is able to produce superior result. Now once again here it is subjectivity, but how to bring objective to this one? So what is superior? So we can tell that superior is defined as 25% or higher result than the normal output. Anything beyond that can be regarded as superior. That is how you bring in objectivity to the nature of subjectivity. And it is clear, it should be clearly a new or innovative use of manpower or either the use of technology, and it should be able to be recognized by at least three different reference as best practice. That is still, it should be recognized by three or more public domain sources who would have put a reference that this practice is yes one of the best of the kind. Mm. It if at all it has received an external award for the practice, it can be regarded as best practice. Now if at all it is recognized by the customers or suppliers, or if it is recognized by industrial expertise, then it can be regarded as best practice. So when the organizations utilizing it have patent for this particular practice, it can be called as best practice. Or if it leads to exceptional performance, it can be a best practice. So an example can be given for this as General Electrics has something called as workout practice. Now it is one of the best practice that is utilized by the organization. Now more than just learning what benchmarking is and what it can do, the organization leaders must always develop a specific organized approach to implementing benchmark. Now it is fine to extol the virtues of benchmarking and encourage its use throughout the organization, but just like any other program, it must be established into the organization as a working process. So there are quite a few steps how it can be done. The first step is you have to determine the process to be benchmarked. The next one is determine organizations to be benchmarked. Once after you know what are the organization that has to be benchmarked, data has to be gathered regarding to that. Now once the data is collected, we can definitely know if there are any kind of gaps within that. Once all these things are known, the future trends are to be determined. Now once after that, it has to try to reveal results and sell this process to the management or the target audience. uh, it has to be sold to. Now seventh one is it has to achieve consensus on all the revised goals. Once after they have achieved the consensus, then the action plan should be established. Now once the plan is established on the paper, then implementing plans and monitoring results would be the next thing. And the last one is that uh, you know uh, recalibrate benchmark should be made. That is, you continuously evaluate the benchmark practicing and the benchmarking process when necessary. So the success of benchmarking process depends on the organization's permanent commitment towards the process. A particular benchmarking change while often to be temporary. So to sustain market leadership, however, the habit of benchmarking must be a permanent part of the organization's culture. So, so these are quite a few things that I had to speak about.